Hello and welcome to a special webinar from Fat Profits. My name is Roger Malik. I'll be your host for today, and I'm also the head of our client services in our Sydney office. Welcome to the webinar. We hope to provide you some good insights on the current market. Thanks for your company. And joining me today is our Senior Account Manager, Edward Allen. Edward, welcome to the webinar. How are you today?
Yes, very good. Hello, everyone. Glad to be on this live presentation again today. We've got a lot to go through, so looking forward to it.
Excellent. Well, as you guys know, the headline for today's webinar is Market Crash or Buying Opportunity. I think that's a common question which a lot of people are asking at the moment, calling their friends, calling their accountants, advisors, and we're getting a lot of calls from our paid members as well on a daily basis as to what's going on in the market. So we're going to provide some insights to you guys today. Even though you're not members of our service, we're going to give as much information as we possibly can, so you walk out of this webinar with some ammunition, some calls to make, and some ideas that you can hopefully learn from. Now, before we get into today's discussion, all our presentations from Fat Profits are general information only. We don't provide any personal advice during this session. If you are looking for that, please see your financial planner or advisor, and also past performance is no indicator of future performance. And finally, we will also have an opportunity where you can ask questions and you can type them in on your screen where you see that little orange arrow pointing towards enter a question, and that'll pop up on our screen, and we will do our best to answer as many questions as possible. Keeping in mind, it is actually absolutely full today, so I can appreciate everyone's sentiment with questions. We've actually got 500 people watching this live at the moment. It's actually booked out, I suppose purely because of what's going on in the market, Edward. So we'll do our best to answer as many questions as we can, and if we don't get to your questions, you can feel free to email us or call us as well. We'll provide all the details to you. So hopefully you've got your pens and papers ready, coffees and beers and wines, whatever time of the day, what part of the world you're in, and we are ready to go. Let's get into the first topic for today. First up is the absolute major event which is shaking the markets. Is everyone's looking at the US Federal Reserve. They've recently had the meeting for 2 days, and they came up with some updates to the market. But I think more importantly than what they actually said is what the market is anticipating. And Ed, look, the US Federal Reserve meeting was pretty much of a non-event because they didn't really say anything which wasn't expected, but it's really what the market is expecting over the next 6 to 12 months is what's spooking the market. So could you shed some lights on what's taking place and what's important in terms of Federal Reserve with the interest rates?
Well, it's all about monetary policy at the moment. The market's got a hangover here, especially over the last week and a half of all this volatility. They're acting like little children in the playground. The big traders, especially in the US, and the fund managers who have been selling down big tech in particular. But big tech's been sold down for one reason, that these companies carry high levels of debt, and they're going to have to pay more for that debt in the future as interest rates rise. So it'll be going up at least a couple of times this year. Once the market gets a grasp of it, it's back to fundamentals, and that's what we're focusing on with our members. Interest rates are going up. We know that. Inflation is up. We know that. We're going to deal with it. We're going to show you how you can protect and diversify and risk averse your portfolio moving forward.
Absolutely. Thank you. Well, as we all know, and if you haven't seen this, you're probably missing out some critical information. The US inflation is skyrocketing. It's at 7%. So in other words, everything is 7% higher than last year. And this is the highest it's been since the last 40 years, since 1982. So this is not something small that we can ignore. And you can look at the breakdown of inflation across board in the US. So starting with gasoline, you got fuel, used cars, utilities, meat and dairy, you got new cars. Look, things are skyrocketing. Overall figure is 7%. So pretty much everything is more expensive than a year ago. And if you think about just things that you're spending on, But more importantly, even rents in the US, and you can see the blue line there. I'll point the mouse there now. You can see they're up 17.8% in 2021, and you can see 2018, 2019, they were up 3 or 2%. 2020, when COVID first came, the rent actually dropped around the world, including the US, by 1.6%, but even the rent's gone up. So now that we know that everything is going more expensive, well, how does that impact the investor? Well, pretty simple. Well, the interest rates have to be risen by the Federal Reserve in order to curb this inflation. They have to. Otherwise, it's going to be out of control. They have to slow down the economy and slow down this inflation. Now, what's happening with volatility? You can see this on the charts. You can see on the left-hand side, when March 2020, when COVID first hit, the volatility in the markets skyrocketed to 85 out of 100. And since then, it's obviously tapered down. But recently, we've seen, you can see on the right-hand side, it's gone up back around just under 40, but now just cooled off a little bit in the last few days, but still pretty high off late. Now, having said that, now that we know the background, so what are investors doing? Well, this is what the investors are doing, which is rotating stocks. So some investors are completely sold out and they want to get back in a bit later, and that's fine. Good luck to them. But long-term investors, what they're doing is they're rotating the sectors. And Ed, this is very typical of when interest rates start to rise, technology stocks get hit, as you mentioned earlier. So technology, a lot of people are moving out of tech stocks and moving into finance, commodities, some into property as well. But what are your thoughts on these sectors in particular, given what we're seeing in the background?
Yeah, absolutely. And that's what we've been doing in our preferred portfolio for our members, is showing them which stocks are, one, infrastructure ready, inflation hedged, the companies that aren't building or constructing, like our commodity stocks, for instance. Most of our explorers are pretty much, a lot of them are actually producing. They're infrastructure ready. So it's the same with property. You want to avoid property stocks. You've seen what's happened with Evergrande in China and a couple of others. They've almost gone bankrupt because they carry high levels of debt. So the stocks that we cover carry low levels of debt, infrastructure ready, inflation hedged. That's what we can show you as part of the service. So, and some of those stock, financials and commodities are a big part of what we do, and property as well. So we're pretty strong. Our portfolio is pretty strong moving forward.
Very good. All right, let's dive into 2022 outlook. Now, at Fat Profits, at the start of every year, in fact, in December, we publish an outlook for the year ahead. So we make a few predictions. One of the predictions we made, and this was published to our members in December, just before we went on our Christmas break. And our CEO, Angus Geddes, he predicted a 15% correction in the US markets in 2022. Well, we must be honest and say, look, we weren't expecting that to come so quickly, but it's come out of the blocks in the first half of January already. So this was our prediction. This is a snippet from our outlook. The S&P 500 trades within a sideways range throughout the 2022 year, incurring a 15% correction along the way, but it manages to close out December around 5,000. So this was one of our predictions for the US market, which affects, of course, everyone in the world. Let's have a look at one of those indexes in the US, NASDAQ, and you can clearly see on the top right here, NASDAQ has actually dropped just shy of 16%, 15.8 to be exact, in the last couple of weeks. And that's led by tech stocks in particular, which we also warned our investors and members to avoid. So that one of our predictions has already come true a little bit sooner than what we probably thought, if we were to be honest. But let's look at the ASX market now as well. How far have we dropped? Well, we've dropped just shy of 10 to 11% in that same time. So a little bit better than the US, but still taken a pretty reasonable hit as well. Now, having said that, our views on the ASX is we think ASX will be fine this year compared to the US market, where we'll see a lot more volatility. And the reasons for that as well, we can go into some of them now, but one of the key reasons is the ASX sector weightings. And Ed, this is really important because when you look at the sector breakdown of the ASX 200, you can see the financials make 31% of the 200, 17% is made by materials, which is commodities, and then followed by the others like healthcare and so on. Now, the key thing from Fat Profit's point of view is we are quite bullish on financials this year. As interest rates rise, we expect the margins for financial companies to also improve, and materials, commodities, to continue to be strong this year. And we'll talk about those two sectors later on in the presentation. But also you look at the IT sector, this 4.7%. It's a very small part of the overall index, but talked about a fair bit. We're also bullish on energy sector. We think energy will remain strong, but not probably as much in, say, real estate. We think real estate will drop this year, especially in the second half. Industrials will be okay, but you've got to know the right stocks. But Ed, your thoughts on the makeup of the ASX 200?
Yeah, consumer discretionary has copped a big hit recently. I noticed the likes of Adairs was one that I noticed in the last few weeks. Kogan, a couple of others. You know, retailers are starting to really struggle as this pandemic is stretched out. Look, not all stocks in financials are going to do well, as we know. Insurance stocks, I noticed recently, the likes of NIB and Medibank Private copped a bit of a hit. Look, for some of those stocks, it'll be a buying opportunity if they pay a very good income. We've been presenting these opportunities to our members, but not all stocks in all sectors are going to do well. Again, it's the companies that are risk averse, inflation hedged, and infrastructure ready, and don't have money to spend on big infrastructure projects in the next 1 to 5 years. Now, those companies are the ones that we're focusing on.
Very good. All right, and finally, looking at the health of the Australian market, another reason why we're reasonably bullish on an Australian stock market is our unemployment rate is down to a 13-year low. We're pretty close to full employment. It's down to 4.2%. When when the pandemic hit, it was 7.5%, had skyrocketed to 22-year high. So that has to have confidence in the economy. People's household savings are up to a massive level, which obviously the government's quite happy about. Economy is in good shape. Yes, the CPI, which is the inflation figure in Australia, has also gone up, but nowhere near the US. So we think the Reserve Bank here in Australia will not raise interest rates, at least for some time to come, compared to our US counterparts. So that'll probably help our stock market, at least for the shorter term, but it's coming as well. And finally, before we start looking at a few stocks, Ed, this is a very interesting chart that I just recently looked at. This is a one-year comparison of the ASX 200 versus the tech sector. So the blue line that you're seeing on your screen is the ASX 200. The red line is the tech sector, and that's taken an absolute beating in January, down 18%. The tech sector. Ed, your thoughts?
Yeah, absolutely. And this is all about debt. Yeah, the debt that these companies carry, but it's also competition that's coming in as well, which is going to impact on their earnings, and that's what the market's factored in. And this is going to affect, the technology sector globally, not just in the US. So we've seen a couple of our big tech stocks already cop a hit here in Australia, in particular in the buy now, pay later sector, and that's just going to continue. So we'll touch on that a bit later. We're going to show a few stocks that we've prepared, but gee, this is anyone that thought tech was going to be the future. Yes, it is, but they're not all going to make money. And the ones that have been hit hard are the ones that have not even made a single cent to date.
Correct. Exactly right. In fact, we've got a couple of comments coming in. I think Joshua just mentioned that, I was lucky enough to sell out of a few tech stocks in December, so I'm feeling a little bit better. We got Helen just mentioned that yes, I am caught up in that sell off in January, unfortunately, but I'm going to hold off for my dear life. Good luck, Helen. Let's look at a few stocks in that space now that we're talking about it. Look, these are the few stocks and sectors that we have avoided for quite some time. There's a few names here. We can't list them all in the same presentation. We'll list a few: ZipPay, Afterpay, Kogan, AGL. We've even avoided cryptocurrencies, although there's a couple of them in Fat Profit's house account that Angus, our CEO, has bought for a little bit of play money, like the likes of Bitcoin and Ethereum he bought a couple of years ago. But in general, we've avoided a lot of them. And let's have a look at a few. And this is just to, again, find a bit of a screenshot from our last update, which was, early in the piece, September 15, 2020, we published a special report on the buy now, pay later sector. And we said our headline was trouble in tech. So, and this is one of the screenshots from there that we said, look, we've effectively sat on the sidelines and we remain really wary of the buy now, pay later space. So we told our members to avoid this. Now, Ed, let's have a look at a few of these stocks. And I know you've been with Fat Profits for a very long time. Ed, I think, what, 11, leading up to 12 years now?
Yeah,
and you speak to a lot of clients.
Very shortly. But look, these were trading stocks. It's as simple as that. I mean, speculators and traders, people that traditionally buy, speculative mining stocks, jumped into this sector. And if you got out at the right time, yes, you would have absolutely made a lot of money. But the ones that were thinking long term are the ones that have actually lost money. So it all comes down to timing. Yes, there would have been unbelievable trades back in 2020 on some of these stocks. I know I did one on this particular one. I feel like a bit of a genius on ZipPay, but you're not going to get them all right. And that's absolutely right. Like, I got that one right. Afterpay, I got completely wrong. So I could have made a lot more money on Afterpay, but they were always going to be trading stocks. They were never going to be stocks that I was going to hold, because, as you know, they're not making any money. So the fundamentals are just not there. And the value trap on these stocks, they've dropped about $1 or $2 a month just in the last few months. So anyone that's tried to catch that falling knife has lost a lot of money on these stocks. A2 Milk is another one. Perennial losses for a lot of people who try to catch that falling knife.
Yeah, absolutely. Look, these are a few stocks that we published in our reports to members, and we've explained our reasons why. I mean, A2 Milk is a classic example as well. When it was $20, it was a darling of the market. People loved A2 Milk, and look, for good reason at the time, but there was trouble brewing in China, and they were heavily reliant on one partner. And when this stock really finally tumbled down to sort of $10, we were getting calls from a lot of our members and non-members saying, what do you think of A2 Milk? $10, that surely is a good entry price. It's down 50%. And we stuck to our guns and we said, no, we are going to avoid this stock. We don't think this is going to turn around anytime soon. There is a lot of issues that they're facing. Until we see some confidence, we're not going to get in, because we only buy stocks when the fundamentals box is absolutely ticked. And look, it's gone down from $10 down to $5. Some might say, look, it's still cheap, but look, at this point in time, we were watching. We're not ruling it out. We may get in, but at this point in time, we're waiting for things to turn around. So that's another example. Kogan, as I think, Ed, you touched on earlier, look, while they make some money, but they've also had a lot of operational issues along with competition as well. So we've avoided this stock, even though it looks cheap on chart, but some people like just the charts and they look at it and they go, well, it looks cheap, let me get in. But really, that's a falling knife. So we've avoided that as well. And finally, AGL, and this is a stock, I think, well, apologies if we're hurting any pain nerves here, but I know a lot of investors hold AGL and they've been sitting on losses, reluctant to sell. Although recently it's pulled up a little bit, but really, Ed, this is a stock which has taken an absolute beating over time.
Yeah, they've done a few deals recently, which is favourable, but whether it's sustainable, I think it's a dead cat bounce more than likely, and I think $8 there'll be a bit of resistance there. So, and those stocks you touched on before, Kogan, supply chain issues affecting that stock. A2 Milk as well, not only China, supply chain issues as well. We're just avoiding all these stocks. So that's the advantage of being a member, is that we don't only tell you what to buy, we tell you what to avoid. Again, we don't get them all right 100%, but we do get most of them right, and that could save you a lot of money, especially on those stocks we've just gone through.
Yeah, thank you. All right, let's have a look at, now that we looked at what we've avoided so far, let's have a look at what we have picked. We'll give you a few recommendations shortly so you can add them to your watch list. But these are the top 10 stocks on the ASX 200 last financial year. So you see this on the right-hand side, this list of stocks, starting with Chalice Mining, CHN. That was the best performer on the ASX, which is, the reason it's highlighted is that was one of our recommendations to our members. Then you got Pilbara Minerals, which was the second best. We did not recommend Pilbara, that's why it's not highlighted. Hub24, number 3, that was one of our recommendations. And Orocobre, the lithium producer. So we picked 3 out of the top 5 on the ASX 200 last year. And look, we have to, take credit when it's due. We're proud of this achievement because not often you get 3 out of the top 5 on the ASX 200. I suppose the question for you, I mean, we've got 500 people watching this webinar today, Ed. I think the question for you guys who are watching this is, did you pick any of these top 10 stocks? If yes, well done to you. I'm sure you're feeling chuffed about it and telling other people. But if you didn't, well, how's your research looking? What can you do better this year, given the markets are volatile? How can you get yourself 1 or 2 of these stocks so that your portfolio starts to look better? So let's have a look at these 3 stocks. So first up, Chalice Mining. It was the best stock on the ASX period. Absolutely skyrocketed. Ed, this is a company we've held for a number of years. What's so special about Chalice? Why was it loved so much by the market last year?
Biggest discovery in Australia in over 20 years. Huge palladium deposit over there in WA. Gold project at Pyramid Hill, and obviously nickel and copper. So they're right, and cobalt. And as you know, cobalt is a major commodity needed for the battery sector going forward. So yeah, just multi-commodity strikes, just one after the other. And the amazing thing is our members, a lot of them, this guy, every time I see this testimonial, it really does make me sick. I wish it was mine. Anyway, it's a true one. I know this member. 5,000 to Chalice at 12 cents, but I've got about 30 or 40 members over the last 2 years that have told me a similar story. 100,000 units at about 30 cents was one of them, which is quite incredible. So, but the good thing about this testimonial is that Grant was only 33 years old. So imagine a new investor coming in, and a lot of our members, advise their siblings, their children as well, as to where to invest their money. And some of them do get into some of these speculative stocks out of our mining report. And there's multiple stories like this. I mean, Australian Strategic Metals is another one, and then there's a whole bunch of them. So yeah, great stories. Buy well, hold, don't panic and sell if it goes up 100 or 200%, because if it's good, it'll be good for a long time. And that's what's happened with Chalice and many others in that space.
Yep. Thank you, Ed. So yeah, this is a stock. It's currently a hold from us, so we're not recommending this as a buy because obviously of its current levels, but it is something you can add to your watch list. And if there is any sort of further pullback, we may turn that into a buy. But at this point in time, it's not recommended. But you can clearly see if you'd invested a small $5,000 or $10,000 like Grant and many of other Ed's clients, Grant's sitting on $500,000 at 33 years of age in just one stock. I mean, he's got many others as well, but you could be sitting on some huge gains. So that was our best performer. Then the third best performer was Hub24. Now, Ed, this is a financial technology platform stock. Maybe people might not have heard of this company, but can you shed some light on this particular stock?
Yeah, absolutely. They're a platform used by retail investors, but also institutions, managed funds in particular. So basically does all the administration for you. Net Wealth have tried to have a stab at this one. There's a few others. Their funds under management just continues to grow. So again, this is one that we hold long term. We buy on weakness. Even in the recent sell-off or the current sell-off, because it's not ended yet, and this stock has done very, very well. So yeah, financial technology platform. It's widely used, highly regarded, and will just continue to grow from here. But it's been a consistent growth, not like those stocks that we showed you previously that were just day trader stocks that are just bought on sentiment and hype, and you can possibly get the timing right and make a quick buck. But this one here, if you just put it in your portfolio at around $1 a share, which is when we originally got in, it just grows every year. It grows $1 a year, sometimes $2 a year, sometimes $5 a year. It just keeps going because it's so unique. It's got very little competition, and the FUM, the funds under management, they'll just continue to grow, and the share price will follow, the valuation will follow, and the rewards will follow.
Very good. Well, the key thing also is we don't not only just tell you when to buy, but we also tell you when not to buy. So at the moment, we're suggesting not to buy this anymore. This is a hold. So that's what we tell you clearly: buy, sell, and hold. So when it becomes a sell, we will update our members. So this is another one. And the final one, which is the 5th best stock on the ASX last year, is a lithium producer called Orocobre. And although they've changed the name now, and we'll announce that shortly, but lithium has been huge. I think it's the most searched or Googled word in the commodity space last year, right? Everyone's looking for the next lithium pop. So what's so special about Orocobre, or now it's called Allchem? But tell us about it.
Well, they're far ahead in the cycle. So they've got their processing plants all set up. Globally, they've got James Bay, they've got Olaroz, Sal de Vida, 100% owned, that one. Naraha, 75%, and Mount Cattlin, 100%. They merged with Galaxy. Obviously, it's called Allchem now. AKE is the stock code, but they're well ahead of the game. I remember when I started here, the stock was trading about $1 a share, and I remember in 2020, I think it was around April, put out a midweek alert to members at $2 a share. I mean, it's gone up 500% since then. Still sitting at about a 450% profit. So it's lithium concentrate supplying the battery makers, which is Toyota and Sony and all the car makers now, Volkswagen. They'll buy the lithium concentrate, and they'll use that concentrate obviously to make the batteries. And the most expensive component of electric cars is the lithium ion battery, which is composed of lithium, copper, and nickel. And that's the way forward. So this company is way ahead. Again, infrastructure ready, inflation hedged, and it's the leader here in Australia, and I believe it's the top 5, number 5 globally as well.
Very good. So this is firmly in our portfolio. It's the 5th largest lithium producer. You're right, Ed. So definitely. So these were the 3 out of the top 5. Now, the key question for you guys now, as the headline of our webinar today, is it a market crash or is it a buying opportunity? Now, everyone knows this man on your screen, Warren Buffett, arguably the best investor in the world, and he's famous for his quotes. And one of his quotes, which we all follow at Fat Profits, is he says, "Be greedy when others are fearful, and be fearful when others are greedy." So at the moment, if you look at the markets, which we showed you earlier, markets have dropped 15% in the US, 10, 11% in Australia. So there is a lot of fear and uncertainty. And this is for those people, if you're sitting on cash right now, any bit of cash, you have to be greedy, because that cash is not doing anything in your bank. It's not getting you any return. In fact, you're going backwards because of inflation. So if you must take action right now, because these markets will not stay down forever. In Fat Profits' view, this is an opportunity to buy some discounted stocks, which are literally on sale. That's how we're calling it. Stocks are on sale right now. Get in. So that's our view. And here's a quick look at how the greed and fear works. And Warren Buffett has been known to take advantage of these volatilities. Is you see when everyone's greedy at the top, there is euphoria, there is exuberance, everyone's happy and they're pleased and they don't want to listen to anyone, everyone is just happy. But then starts some drop in the markets, some fear kicks in, panic, and everyone starts to feel really uncertain. And this is where we're at now, where people are unsure how much interest rates are going to go up by, what's going to happen in inflation. And this is where we're suggesting put that cash to work and you watch that grow over a period of time. And if you repeat this over and over time, over a long period of time, you will find yourself making some serious money. So that's our general advice to you right now. But also just finally, and I'm sure Eds, you've got something to say about this topic because you've been investing as well for a long time.
Yeah.
Is Warren Buffett and Charlie Munger, they both always say the reason we've made a lot of money is not by buying stocks at the right time or selling stocks at the right time. It's by holding stocks for a long period of time. Now, at Fat Profits, that's what we do. We're not trying to time the market. We're trying to buy good quality names and hold them for a long period of time. So Ed, over to you. What are your thoughts?
Yeah, look, that's our strategy. I mean, some investors may not follow that strategy. They might take the profit at the top and try and time the market. This is where our reports can help because obviously we have buying opportunities every week. And then when the market does fall, like it did recently, and is continuing to be quite volatile, we'll show you where the opportunities are. So you can put money in or take money out. It's your choice. I know I just bought 3 stocks, 3 of my worst performers that I want to hold long term. I've just accumulated more stock at almost the bottom, not quite, but I'm pretty happy that I put cash that was sitting in my super fund. I've topped up on those 3 stocks, so I've average costed in, and I've accumulated at the right time, I believe, and I'll continue to hold those stocks. And 2 out of those 3 stocks pay dividends as well, so I'm going to get more income rather than sitting there in cash. So that was a good buying opportunity for me, and I wouldn't have been able to buy those stocks unless the market corrected. So it is all about timing, but it's all about how long you hold the stocks for. And some of our biggest winners, pretty much all of them actually, we held for the right period of time.
Correct, and that's a common mistake a lot of people make, is sell too early, and that's what we can help you with. Now, just a quick background about Fat Profits, who we are. Some of you might be familiar with Fat Profits. So here's a picture of our CEO, Angus Geddes. He is also a fund manager, and he launched our Fat Profits company in 2000 in our Sydney office. That's where we are, in Market Street, just close to Darling Harbour. That's where we're based. We also went into London in 2003, so we've got an office in the UK. In 2007, we also opened a wealth management division where we manage real money in the markets, and we've got listed funds. We also have managed portfolios. And finally, in 2012, we went into Auckland. So we've got offices in 3 international locations. We have analysts who are all around the world. They look at different markets. What do? We are not stockbrokers. So we don't manage your money. We don't charge commission. We don't touch your money. You simply manage it yourself. We provide the stock market research to you. So we tell you when to buy, when to sell, which stocks to buy, when to avoid, and when to get back in. So that's what our research does, and you get that on a daily and weekly basis from us. We also have David Lennox, who is our mining analyst, and you may have seen him also on a lot of TV channels like Ausbiz or Fox News in the past, and he covers all the mining and commodity stocks for us. He's very popular in that space, an absolute expert, and some of these stocks you saw earlier, they are stock picks from David Lennox, so that's him. And finally, look, we've got a wealth management division where we also manage real money. And the orange line, you can see that's our Fat Profits Australian portfolio. And this is just over the last 12 months, and it's gone up 36% versus the market. So we've been typically outperforming the market for a very long time as well. So that's another part of our business. Ed, let's talk about commodities now. We will talk about financials and commodities today, and that's the 2 sectors that we do think you will make some good money. And we'll give you a couple of stock ideas. But we'll also give you some other stocks outside of financials commodities. So let's look at the first one, is nickel. Now, you touched a little bit earlier on electric cars. But we'll look at nickel and lithium. I mean, these stock prices have really skyrocketed. So what's your take on nickel and lithium?
Yeah, look, nickel price continues to grow. The demand is there. Again, we're not chasing the explorers. We have a couple of explorers that have picked up some significant strikes recently. They'll become producers, but the stocks that are performing really well, the ones that are infrastructure ready and producing, and we have most of the top ones in our portfolio. But the nickel demand is just going to continue to grow. The spot price will remain high in this environment because some of these smaller explorers that have found deposits are going to struggle to build their infrastructure plants in this environment. They're going to need a lot of money to get that infrastructure ready. It's going to take 5 years plus in this environment. It's going to be an expensive exercise. A lot of them will probably hold and sit on those deposits, and they won't be producing anytime soon. So we've got the stocks there. Lithium concentrate, same thing. There's been a couple of spodumite auctions recently that have been well publicized, where companies are trying to outbid themselves, trying to get hold of these deposits. There's plenty of lithium coming on stream, plenty of it, and plenty of exploration. So don't get caught too much in the hype. Some of these smaller explorers that are, looking like they're going to go to the moon, they probably already have, to be honest. A lot of them are fully priced in. But we've got one explorer that's just tripled in the last month because they've signed off an offtake and a royalty agreement on one of the lithium mines in Canada. So it just shows you how quick these stocks can move. So yeah, demand is there, supply is definitely there as well. So don't get caught into that supply trap, thinking that these are the only companies that have got the supply. There's plenty more coming, but we're focusing on the companies that are not only producing, or the ones that are close to producing, but also the ones that have we've got a smaller nickel producer actually that's producing nicely. I think it only trades around 27, 28 cents. These are the type of stocks that we're focusing on at the moment. But those two commodities, well in demand and absolutely been performing in our portfolios.
Absolutely. Exactly. And if you don't have any exposure to some quality lithium and nickel stocks in particular, look, we'll give you a couple of ideas, but look, there's absolute opportunity in that space. But finally, another commodity that we're quite bullish on this year as well, iron ore, which has dropped dramatically last year towards the second half from $220 a ton down to $85 a ton. That was a massive drop. And we all saw the likes of BHP, Rio Tinto, Fortescue Metals really take a bit of a tumble. But it has recovered now to closer to that $130 to $140 a mark. And we think it'll remain at sort of these levels, somewhere between 120 to 150 this year. And the likes of BHP, Rio and Fortescue will benefit from these higher iron ore prices. And this month in February, we're expecting some good updates from these companies and some reasonably good dividends as well. So look, overall, we're quite happy with where iron ore is at. Let's dive into a few stocks now. So first stock is ASM, Australian Strategic Materials. We've got a buy on this stock. Ed, tell us briefly about who they are, what they do, and of course, recently we can see the share price pull back. So this looks like a reasonable opportunity.
Yeah, it originally was a spin-off from Alkane Resources, a stock that we'd held for over 10 years in Dubbo, zirconium, multi-element, rare earths. They've done a few deals overseas recently. The chief there's gone around and signed off on a few production deals. They'll be sending the product offshore and producing it in those countries. So they're going to spread their reach. But this is a stock that went from $1.43. Our Alkane shareholders got some units in there as well, and then we maintained the coverage on Australian Strategic Metals. So anyone that held those stocks and bought in early at those levels, the price shot up to $14. And I mean, even we couldn't even believe what's happened. But if you look at stocks like Lynas, for instance, which has done similar things on the charts, is that this rare earth space is hot. It's not as expansive as lithium and nickel, so it is a lot harder to find these deposits. But again, there's a couple of small ones that found some pretty good deposits, but they've got zero infrastructure. So how they're going to get that to market is going to be very difficult the next couple of years. But we've got a leader here, Australian Strategic Metals, in the rare earth industry, well established and well and truly on its way. And we're currently reviewing the share price because it did go up. It was originally a 10 bagger for us, which we're proud of. And now it's come back to relative levels. So the valuation is much higher than the current share price. But again, we don't want to chase. We need to buy on value and on fundamentals. And some money's come out of some of these big performers recently. So we'll have to time it correctly. Is there more to go? That's currently under review, or is it the time to buy? And we'll let members know.
Okay. Thank you, Ed. So that's the first one to look at. Another stock, which I think, Ed, you briefly touched on earlier, which is a junior explorer, Essential Metals, ESS, and that's shot up, even though the markets have dropped dramatically in the last few weeks. But if you own the right stocks, you can still make some money. So this stock has jumped up 3 times in the last 1 month. So what's happening here?
Well, yeah, I mean, share price wise, it went from 20 cents to 60 cents. With the recent sell-off, it dropped down to 40 cents. And then just recently, again, it was bought back up. So that shows relative strength. I believe it was in Canada. They've signed off, with Mavis Lakes. They'll get royalties from that. Lithium. They've also got Lithium Dome here in Australia. They've also got a gold project as well, which they've been developing for well over 15 years now, probably even longer. Used to be called Pioneer Resources back in the day. So they don't have, because they did a share consolidation. The reason the share price is very strong currently, I think they did a 10-for-1 share consolidation. So there's not a lot of shares on issue. So when these things rise, we've got about 4 of these that have done share consolidation. So yes, in the past, some investors have lost a bit of money on them. But if you held on, because they don't have a lot of shares on issue, the share price rockets up quickly, and it holds. And that's what's happened here. So multi-commodity. They've got the lithium. The lithium has been the catalyst for the recent spike in share price, but they've also got gold as well. So gold will come back this year at some point as inflation continues to, rise its head around. Gold will eventually have its place. So this could be a big winner going forward.
Okay. All right. And finally, before we look at some others, let's have a quick look at Medibank. I know you touched on that earlier, Ed, that the insurance companies, especially the likes of NIB, Medibank, recently come under a bit of pressure, but Medibank has been in our portfolio. And what's your take on these type of companies, which some of our audience might be holding or looking at the moment?
Yeah, absolutely. It's one of these boring stocks that you can just stick in there. You'll get the dividends, which is very strong, but the share price won't do a lot. If you look at that chart, it hasn't been flash. Initial float was about $2. It's currently around $3. It's been as high as $3.50, $3.60 recently. You can see at the end of that chart, it's had a big drop. That's got a lot to do with the current pullback in the market, but also the healthcare insurance sector's come under a bit of pressure as COVID cases rise. Deaths are rising as well. People reluctant to get out and get their eyes tested and all that sort of stuff. So there's a lot happening, but this business is rock solid. Their financials are very strong. Their dividends are strong. It's probably a boring stock that I'd like to own and know that my money's still going to be there in 10 years' time. So it's been a consistent performer, but it's not going to shoot the lights out. But Medibank's always said they're going to grow. They're going to grow their healthcare arm. It's not just going to be insurance. So that's why we like it, and we're waiting for that growth phase to kick in.
Okay. Thank you for that update. And let's have a look at some of our sale recommendations. So far we've seen stocks to avoid. So far we've also seen a few stocks to buy. Now let's look at a few stocks that we have sold recently. So you've got some likes of Boral, you've got Vocus Group, you've got Domino's Pizza, and a few others, Nine Entertainment. So we won't go through all of them, but these are all the stocks we've sold in the last 12 months, 2021. And now all this is on our website. So we're one of the very few companies which are completely open and transparent. All our winners and losers, every single thing is black and white and is published on our website. So we got 10 winners last year and 2 losers. And look, overall, if you can get that, I think most people will be pretty happy. But if you'd invested $10,000 in each of these stocks, that will be your returns in terms of growth. So pretty reasonable returns there. We'll share a few stocks that you can have a look at. I mean, Mainstream is no longer on the market because they actually got bought out. That's a financial technology stock. And you can see there on the charts, we bought them in 2019 at 62 cents. And for a while, look, it was just going sort of sideways, but the funds under management were growing. And then the appreciation came post-COVID, and the stock started going up, and we put a few more buys at 57 cents and 95 cents. And then they got a first bid to be bought out at $1.20 from Vistra. So we were clear to our members when they were offered $1.20. A lot of our members were happy to say, should we sell? We're ahead. We can make some money and move on. But we were very clear to say, no, we think it's undervalued at $1.20. We will be happy to hold. The board actually rejected the offer. They said it's undervalued, and we supported that. And then came a few months later, more bidding came from other companies, $2, $2.25, you can see there. And eventually it got sold at $2.80. So patience from us to our members actually got rewarded. This was a great outcome from 60, 70, 80 cents where people bought it to sell it at 2.80. Look, that was a great outcome. So that one is completely out of our portfolio. But this stock is interesting, Nine Entertainment, Ed, because they not only own, of course, the typical channels of Nine Now, and all sorts of channels, but they also own Stan, the online streaming service, and 60% of domain.com.au. And recently, as we can see, they've also signed a contract with the NRL. Ed, tell us about it.
Yeah, they've renewed their agreement. I believe it's for another 5 years. I believe they're even showing the trials now as well. So there's quite a bit going on in this space. The Australian Open it's probably going to end up being the top ratings for the whole year. And you've seen the success of Ash Barty and the Australian players, Nick Kyrgios and so forth, and Kokkinakis, all collecting trophies in the Australian Open. So it's been a great time for this company. NEC, their numbers are going through the roof. NRL's around the corner. And Stan has released a show called Gold, which I've been watching, and previously Billions, which is very popular. It's stock market related. Shows a lot of greed in that one. So yeah, this stock fundamentally great dividend player, consistent growth, solid portfolio stock. I believe it's in our income portfolio as well. That's right, it is. It's been there for a while.
Yep.
I remember during COVID, the stock went down about $1 a share, bounced back and hit a high of about $3.50. We took some profits there, $3.02 around that price, and then we bought back in again at lower levels. So great success story for us. Fairfax, obviously, has a play, or the old Domain Holdings. There's a few fingers in the pie there. So we've had all these stocks in the portfolio, and we've done well out of every single one of them. So yeah, this is a good portfolio stock to hold.
Okay, thanks, Ed. So you can see there we sold half at $3.02, and actually turned out to be a good call. And now that it's pulled back, we're reviewing that stock as well to see whether they want to go back in or not. And just a couple more stocks. Boral, the construction company, we've had this stock for some time. They've actually done quite well. They've had a number of projects around the country, and we sold half at $7.41, where we see an opportunity to lock in some profits. Turned out to be the absolute peak, purely in hindsight, but maybe a bit of luck as well. But since then, it's actually pulled back at just under sort of $6. So we've gone back in one more time to buy at $5.98. So these are the sort of calls that we provide to our members, is to when to buy, when to sell, whether it's half or complete sells, and if it pulls back and we see the fundamentals still around, we'll go back in as a buy. So if that's what you're looking for, we can provide that to you. And look, another stock, domain.com.au, is the second biggest real estate website in Australia. And we've had this stock for about 3-4 years. So 345 was the initial buy. We held it and held it. And recently we sold half at $5.38. And it's actually come quite a fair bit down since then. And at the moment, we're just sitting back and reviewing this, but that's another opportunity where we've locked in some profit. So these are the type of calls that we will generate for you. Now, for anybody, and we're going to publish just shortly in a second, we're going to talk about an opportunity for people to join our service today. We actually have a stock which is absolutely hot in our opinion. This is a gold mining company, which, as you can see there, it's brand new setup. This is a new mine, and that's actually ready for production. We are really excited about this stock at Fat Profits. The reason for that is here. You can read that this is one of Australia's top 10 gold deposits by Ore Reserve. And you see some of the names you may be familiar with, but this red dot, if you like, or the circle, is where this company sits in terms of gold deposits. So one of the top 10 gold deposits in Australia at the moment. And you can see West Gold is another one very similar to this. Gold Road, a little bit bigger than this. And their share price of West Gold is sort of $1.80. Gold Road is probably $1.30 to $1.50 at the moment. And this company is about to ramp up their production. You can see what's happening there at the moment. This is the latest update. The mill components have been installed. They are getting ready for production. The power station has been commissioned for February. So that's all underway, and the crushers are getting installed. All the works are now almost complete. So what's happening next? You can see the timeline with this company, and this is what gets us excited. All these boxes have been ticked in the red, and this is where we're at now. The long red line is site construction, installation, and commissioning. That's taking place at the moment in 2022, the first quarter. And the bottom of this is full production in the June quarter of this year. So in the second quarter of this year, that's when they're going to pour the first bar of gold. And that's what we're looking forward to. And look, this is not the only mine. They also have another mine in a different location where they've been producing gold already. So they're not a complete explorer. They have been producing gold, and these are some numbers for the last few quarters. But this brand new mine is what's getting us excited. So Ed, just looking at this chart as well, we've held this stock for some time, and we can see that this stock's gone from sort of 5 cents a share a few years ago to as high as probably 37 cents. And recently it's come up from when they raised some capital at 15 cents. It's gone up to just shy of 30, so floating between 25 and 30 cents. What are the chances of this stock to do something similar to a Gold Road or a West Gold, where it could be somewhere between $1.50 and $2 like the others?
Yeah, well, look, again, it's one that's been consistently growing. That's why we like it. It's one that you can stick in the portfolio. You know, the infrastructure ready, something I've been harping on for quite a while with our members, is to focus on stocks that are infrastructure ready. You know, all those explorers in WA that have found gold in the last year or two, they don't have a single hole drilled in the ground for infrastructure. So that gold could be sitting in the ground probably for another 5 years before they even consider doing anything. So the fact that this one's going to be producing this year, and their infrastructure ready, they even got a tennis court. Did you notice the tennis court in that photo?
Yes, yeah, I saw that.
Whoever works for this company is going to enjoy some pretty good lifestyle on the weekends or their days off. Not only you know, looking for gold, they'll be playing some tennis as well. So so yeah, we like this one, and there's a few others like that in our mining report as well. And you get that as part of the premium membership. But this stock's ready to go. It's consistently growing, and we believe it will consistently grow again the next couple of years. And who knows, it could shoot the lights out.
Absolutely. Look, 26 cents at the moment. This is a great opportunity. So for those of you interested in looking at these good stocks, well, we're going to give you an opportunity now. So first up, let's have a quick look at Fat Profits performance. So this is what most people are interested in. is our annual returns. And as we mentioned earlier, we're one of the very few companies who publish all our results on our website. So you don't even have to watch this webinar to do this. It's all on fatprofits.com.au. And we've just taken that screenshot. So the annualized returns since 2000 are 17.8% in the Australian market. That is a very good number, very hard to achieve. And the ASX at the same time has done 8.5%. So we've outperformed the market by 9.3% per year. That's not easy to achieve. We've done that. Now, having said that, we are not perfect. So I don't want anyone to get an impression that we get everything right and we are just perfect investors. We're not. Nobody is. And here's a proof of that. In 2020, look, we've done pretty good. The markets did 3.6%. We've done 20%. So we've outperformed the market. In 2019 is where, look, the markets actually got the better of us. The markets did 24%. We only did 19%. So we were underperforming the market by just shy of 5%. So we will take that on the chin. Some of our stock picks did not do as well as we were hoping for. But look, we've got a result which is reasonable. But 2018, we were very happy. The markets were in the red and we got 10%. 2017, we doubled the market returns. 2016, similar. And 2015, look, the markets were in the red and we had a fantastic year in 2015, nearly 18% in the green. So look, overall, we do get it right more often than not. Do we get it right every single time? No, we don't. But overall, if we can get you somewhere around that 18 to 20% returns a year, what would that mean for you? How would that look like in your portfolio? And if you can do that over a long period of time, and this is what it looks like. If you actually do the numbers, and we've done all the numbers, is if you invested back in 2000, if you invested only a small $10,000 for the whole year into our stock picks and just let it sit there, and then annually, all you did was $5,000 per year, you invested in the market using our stock picks, and just every year just chucked in $5,000, nothing more, you'll be sitting on today $1.6 million in your portfolio. And I'll say that again, it's only $5,000 per year, nothing more than that. And we know that you're probably investing a lot more than that in the market. So what we're saying to you is the power of long-term investing, compounding returns, 17 to 18% a year. If you just let that sit there in your portfolio over a long period of time, that's what's going to create wealth for you and your family. And we're proud of doing that for thousands of members over the last 20 years. And look, here's some reviews, Ed. I mean, you've got probably some of these members who talk to you all the time, and we've got reviews from real people.
Yeah, Alan Jones, definitely, from Perth. So these are real reviews. A lot of those reviews are just new ones, but a lot of them have been with us for 15 years plus. But I've noticed a lot of the new ones. People that came in during COVID and also during 2020, 2021, only joined up for about a year and made quite a bit of money. And there's others telling us that they're on their way to successful investing because they got it right from the start. But even October last year, when the market dropped, a lot of my members said they topped up again, they put excess cash in the market, and they've done well. And then those same people are getting in again. So we've got the right stocks. Remember, we only cover 50 to 60 stocks out of a market of almost 2,000 companies. So we make it very easy for you as a member, and you will get a return. And my philosophy has always been from the start. I learned this very early. Spread your wings wide, not thin, which means more stocks and less in each stock, rather than more in less stocks, which means you're relying on a few to do well, rather than a basket of stocks to do well. And the basket of stocks always does better, because if you can get 7 or 8 out of 10 right, you'll do very, very well in this market. If you can get 14 or 15 out of 20 doing really well, you'll definitely make a lot of money in this market. So spread the wings wide, not thin. The only people I ever hear that lost money with us are the ones that just bought 1 or 2 stocks and are relying on those 1 or 2 stocks to perform.
Yep, absolutely. So look, for those people, look, I'm getting a few questions here, so I'm going to get to those questions shortly. Look, there's a few people showing interest in our service, very happy with these results. So look, for them, we've got a special offer today, and I know a lot of you are sitting on some level of cash wanting to take some action. We're offering up to 50% off for you to join our service today. And it's a very small part of your overall investment. And we encourage you to take that action today, and we can help you get into a few quality stocks right away and also tell you which ones to avoid. Now, in order for you to take place, let's explain to you first what are the three types of memberships we have. So Ed, we've got three types of memberships. I suppose a quick intro would be good. Look, standard membership gives you daily emails from our CEO about markets every morning. You get weekly members webinars, just like this one. Every Thursday, we do a live webinar for our members at 12 p.m. on a Thursday. But if you miss the live session, you get a recording, so you can replay that later. Every Friday, you get a wrap up of the week, all the highlights, and you also get access to one of these 4 reports. So you can choose Australian equities, which covers all of Australia, a little bit of New Zealand and Asia. You can choose the mining report, which has certainly got a lot of small caps up to blue chips across mining in Australia and overseas. We've also got a global equities report, which covers US, Europe, and Asia. So you can pick those international markets for research, or you can choose UK equities. So as a standard member, you can choose 1 of 4 reports, whereas a premium member, I think, Ed, that's where the key difference is between premium and platinum. So can you tell us a brief difference between those two?
Yeah, absolutely. Look, most of our members are premium members. They get the premium account management service. We've got junior and senior account managers here. I'm obviously the senior, so I've been here for a long time. So I look after a lot of our long-term members, but I'm happy to take on new members all the time. I've had a few members retire last year, just cashed out of the market, decided to put their feet up and go fishing. That's fine. They've made plenty of money, so they can do that. But a lot of our members are self-funded retirees. They rely on the income and the money they get out of a market to live on. They can't get benefits and all of that. So that's our most popular membership. You get some support, especially now when the markets get really volatile, like we've seen recently. You can give us a call or send us an email. Most of my members email me with questions. Ed, I'm a bit nervous. This stock's gone down 20%. Should I hold or buy more or just sell? It's no harm asking those questions if you're a bit nervous, but generally, if you follow our strategy, you'll be right. But that account management service is definitely beneficial, and that's what differentiates us from the rest, because most of our competitors provide insights in the market. Some do provide recommendations, but they don't provide performance figures, so they don't hire an external auditor to audit the figures, so you don't ever see performance on their website. So the fact that we're as close as you'll get to a full service broker without the broker. Okay, and it's a good time to join because the market has corrected, and generally anyone that's got money sitting on the sidelines, I find a lot of those people join on the website without even speaking to us. They pay the full retail cost. That's fine. We'd rather you do that. But the reason we've got some offers today is that we actually generally want people, especially people that have been sitting on a database for 10 years. I've noticed every time I do these, I see people from 2016 right through to 2006, email addresses that were registered in 2006 that have never joined. And it's always encouraging when they do eventually join, because for some of these people, it's just about timing as well. I know a lot of people that joined us early in January of this year had been on our database for over 10 years, but they just said we just watch things, but we never really had money to put in the market. And now we've recently sold an investment property or taken some money out of our offset account, and we want to put that money into shares. So that's fine. So that's what we're here for. We're here to help. The platinum membership can include premium. Most people go for Australian equities and global mining. That's the Australian stocks, with some global mining stocks. But the platinum has global equities, which covers US, Asia, and Europe, and also UK equities straight out of our London office. So the London Stock Exchange, FTSE. So that's your full platinum membership there. With platinum memberships also, if you're a platinum member, we haven't got it on here, but I generally provide my platinum members who subscribe to all of our portfolios a portfolio review whenever they request it. So usually it's about once a year, or initially when they join. So if anyone takes up the platinum membership, I always offer the portfolio review from day one. You pay a bit extra for the service, but we'll give you a little bit more, and that portfolio review is very well received, especially in the current market. If you try us out for a year on platinum, I'll offer you a portfolio review as well. So keep that in mind.
Okay.
So look, there's a poll there which Roger will go through. It's a simple poll. Go ahead, Roger.
Yeah, thanks, Ed. So look, we've got the question in front of you. All you've got to do is pick which one out of those options suits you. Now, we'll take some questions in the meantime, but premium seems to be, I'm getting quite a few responses on premium. There's a few on platinum. So international investors usually go for platinum, and Australian investors would typically go for premium because it gives you Australian equities and the mining. And with this sale on, up to 50% off, look, it won't cost you a lot, but it will certainly reward you with some great ideas, and it'll pay itself off many times over. So look, while you guys are selecting your choices, I'll take a few questions. So Edward, Julie asked a question earlier. She's saying, look, I'm very impressed by your annual returns, and I wish my portfolio was reflecting the same. The question she's got is, how are your annual returns measured? Will I get the same results if I pick your stocks?
Well, look, it's a hypothetical portfolio. So it's basically if you put $1,000 in each of the stock that we recommend. So let's say we've got 50 stocks. So you put 1,000 in, or if you haven't got 1,000, you put 500 in, or whatever's suitable. That's how our performance figures are measured. And then we have an annualized return. So external auditors like KPMG, we hire them, they do the audit. So it's for holding the stock for the whole year, taking into account any sell halves or full sells that we do. So if we sell half or a full sell, if it's a full sell, you know, it's basically we held it for 6 months or 3 months. It's only calculated on those 3 months that we held it. And then obviously the returns, the annualized returns are calculated as well. So it's a hypothetical portfolio. It's based on $1,000 or 1,000 units, it could be in each stock, depending on the size of your portfolio. But generally it's $1,000 per stock. And it's an annualized return. So you would have had to buy all the stocks to get those returns. Okay. But it's purely a figure to measure our performance. So you can see how well we've done or not so well. That's pretty much what it's all about.
All right. Thanks, Ed. Next question is from Mark. He's saying, how long is the subscription for? Is it annual subscription, or are there better discounts if you go for a little bit longer time than 1 year? Because I'm a medium to long-term investor, he says.
Yeah. Look, most new investors would try us out for 1 year, and most savvy investors, experienced investors, would generally want to get a better deal and go for a longer term subscription. So the up to 50% off can go up to, look, we try and keep it at 4 years maximum. Our current renewals used to be 5 years. We've narrowed it down to 4 years now. And look, usually a 4-year membership here at Fat Profits is about $5,000. So if somebody wants to lock in 4 years of premium, we could probably offer it for half of that today. But generally, most people join for 1 and 2 years on the membership. And that gives you plenty of time. Well, the first year you should be able to pick up a few stocks and make some money. 2 years, you definitely should be able to make some money over that period of time. And if investors are paying out of their super funds, they generally don't like to, well, our members generally don't like to pay every 12 months out of their super fund. So they try and lock in a longer term plan, 2, 3, or 4 years, basically. And you get some better value there. If anyone wants to come on board and do a 3 or 4 year membership with us, look, I could probably work out a portfolio review for as part of that offer.
Yep. Okay, great. All right, look, I'm going to close the question now. Looks like there's a fair few responses. So thank you for that. And for all of you who are joining us today, you will get that mystery stock that we just published before, that gold mining company, which is currently at 25 to 30 cents a share price. And we'll be providing that to everyone who's joining today. So hopefully you can get in and be happy in 1 to 2 years from now. So I'm just going to close that now, and we'll just wrap up The final piece of today's webinar, I know there's a few more questions coming through, is a financial sector. Now, we touched on that earlier. We are bullish on financials and commodities. The banking sector, and you can see the chart there in March 2020, it had actually dropped, and since then it has recovered. We do think this will continue to be supporting the Australian market, and we are bullish on that sector overall. Short term, yes, it's a little bit under pressure right now, but we're thinking 1 to 2 to 3 years from here, we are going to see some green lights coming out of this space. And one recommendation we can give you today is Westpac, and that has come under pressure of late. We've got a select few banks that are in our portfolio, not every bank, but currently looking at Westpac, which has dropped recently. We're seeing this as a great buying opportunity. If you pick them up at current prices, you're looking 5 to 6% dividends at the very least, fully franked as well. And then we're looking at further improved margins and improved earnings from here. So at $20 or $21 at the moment, we should see that rise back past that $26 and beyond in the next couple of years. So there is opportunity to make some money. That brings us to today's end of today's presentation. I will take one last question. There's a number of them. So guys, if you're still unsure about anything, you want to discuss something with us, there's a phone number on your screen, 1300 881177. You can ring that up, or you can email us at info@fatprofits.com.au. And you can ask for Edward Allen, who's on the panel today, or Roger Malik, which is myself. We'll be happy to answer your questions. But I'll take one final question, Edward. This is from John, who said, I'm very impressed with Fat Profits. I've heard about it from a lot of people in the past. I am keen to join your service today. My question is, what can I discuss with the account manager?
Yeah, look, no personal advice, but generally members ring up and they say, oh, look, Ed, I'm looking at 3 or 4 stocks in one particular sector. We can discuss those stocks, the pros and cons, and then the member can go away and make their own decision. Because sometimes members do look at, now they might look at 5 recommendations in a similar sector, and they just find it hard to pick the one. But ultimately, as a self-guided investor, that's your job. Our job is to provide you with the information and make it a bit easier for you. But yeah, happy to have those discussions, but we just got to be careful bordering on personal advice. But just while I've got that question on, I do get a lot of members ringing when more members ring in when the markets are down, more so when the markets are up. So sometimes you don't hear from members for a year or so or 2 years, and they'll just ring you out of the blue when the markets start to capitulate. Sometimes because they're nervous, sometimes because they actually want to put some more money into the market. So happy to help.
Okay, excellent. All right, well, thanks everyone for your company. Hope you got something good out of today's session. And for those of you who've shown interest in joining our service, we'll be in touch with you, and we'll be happy to answer any further questions and get you involved. And look, in the meantime, I wish you everyone a safety out there with COVID, and of course, all the best with the stock market. So my name's Roger. Thanks for your company, and I'll pass it on to Edward for his final words.
Yeah, look, happy to assist. Always exciting when new members join. This presentation is designed to give you a real good snapshot of the service. Hopefully you've answered all your questions. If we haven't, just get in contact and we'll be happy to help. And hopefully you can try us out.
Okay, bye for now.
See ya.